Welcome to Capital Creek's 3 in 10 podcast. I am your host, Scott Slayton, strategist and partner at Capital Creek Partners in Austin, Texas. This week, your 3 things are: 1. The Fed leaves rates unchanged. Is Jay at risk of being late again? Number 2, the ISM Services Index, strong across the board. Number 3, the next move for equities. We think it's lower. So let's start with number 1, the Fed leaving rates unchanged. We believe the Fed was wise in waiting to cut again. They're in a very tough position. They're flying blind. They really don't know the ultimate impact of tariffs. They don't even know what the ultimate tariff rates are going to be. But we see the risks accumulating on the downside, and failure to anticipate could lead to a recession later in 2025. By that I mean if the Fed doesn't anticipate and cut more quickly, if they stay on hold month after month, it could lead to some recessionary impacts later in the year. They're watching the data. Of course, Chair Powell always wants to watch the data, but the data are mostly backward looking, and he's at risk of being late again. But we think the chairman would prefer to be late in cutting rates rather than having to hike later this year if inflation surprises to the upside. We understand, we get it. However, we expect a 25 basis point rate cut on June 18th. We see weaker data, softer equities, and halting trade progress. Interestingly, the market's only pricing a 17% probability of a June rate cut. We would put it above 50%. Number 2, the ISM Services Index. Like we said, it was strong across the board. It beat all the survey estimates on every single line item, and it beat the priors on every single line item, something we like to see for good, strong data. The U.S. services economy, frankly, looks resilient. We're impressed. And remember, the services economy is 70% of the U.S. economy. So consumers still have jobs and income, and we think they're mostly tariff agnostic. They really don't care about this Washington gamesmanship, except if prices begin to rise. And incidentally, the ISM prices paid number jumped to the highest levels since early 2023. We think some tariff-related price hikes are beginning to bleed into the U.S. services economy. So this was an important piece of survey data showing the economy in decent shape. And we like to combine the ISM services number with the ISM manufacturing number and look at the composite, which came in at 51.3, solidly above 50 and right at the average of the last 2.5 years. Pretty darn good. Number 3, the next move for equities. We think lower. Of course, the tariff noise has peaked, which is certainly bullish. Treasury yields have settled down into a 4.25, 4.40 range on 10s. Check that box, that's good. The S&P has rallied a stunning 17 percentage points since the lows of April 7th and put together a 9 straight day rally, which hasn't happened in almost 20 years. So a fantastic rally off the lows. So what's next after retracing more than 50% of that down move? Well, we think we're in the eye of the hurricane. We think the frontal part of the hurricane hit the equity markets and treasury markets and the dollar all at the same time, right on Liberation Day and the days following. This is a big storm, so the eye of the hurricane can be pretty big. We think it could be a couple of months before the back end of the hurricane sweeps through, when we start to see the true impact of tariffs, not only on employment and on the data and on the growth of the economy, but also on prices. we think capital probably continues to exit the US for cheaper markets with better policy making. Think of Germany. They're cutting rates in Europe. Germany's fiscal spending is going to be massive. Rates are lower there. There's better policy making in Europe. And arguably in Asia too, where China is stimulating like crazy to keep their economy afloat. So the liquidity from policy making in Europe and Asia and even Latin America is going to benefit all financial assets, but we think they'll benefit the US assets the least. So look at the US dollar, the very weak rally, or I should say no rally in the US dollar, shows there's still an ocean of dollars to sell and liquidate. How about this 2-day move in the Taiwan dollar, 9% down in 2 days? We think this is a harbinger of things to come, and there's still a lot of length to liquidate in dollars. So there you have it. That's your 3 in 10 podcast. Thanks for listening. See our website under Capital Creek Partners Market Insights for our latest written research. And as always, be careful out there.